So for the first session now, Global Wealth Money in Motion, it's my pleasure to invite Shamit Choksi. I'll give a brief introduction about Shamit. Shamit is the director of CFA Society India, leads our PL committee. Professionally, he's the offshore fund manager of international business at ICICI Pru AMC. He has 17 years of experience and has experience across investing, manager selection, products, global asset rating, etc. He has previously worked with Nippon Life India Asset Management in Mumbai and in Tokyo. He is an MBA from Boston College. He's a CFA charter holder and a board member, and he leads the professional learning committee, as I mentioned. Shamit, please do come on.
Okay. Thanks, Kunal. So yeah, we begin the first session, and it's my honor to invite Mr. Dan Farley to take us through about money in motion. That's the topic that he is be presenting today. A brief background of Dan. He's the Chief Investment Officer for the Investment Solutions Group at State Street Global Advisors. He's oversees over 75 investment professionals with over $180 billion of assets under management across multi-asset portfolios, tactical asset allocation, liability-driven investing, and he also works with clients in developing custom model portfolios to meet their specific objectives. He's also a member of the Executive Management Group, and prior to this role, he was responsible for the US Multi-Asset Solutions team. Dan holds an MBA from Bentley College, or Bentley University, a Bachelor of Science in Business Administration from Stonehill College, and he has earned the Chartered Financial Analyst designation. He's a member of the CFA Institute and also the Boston Security Analyst Society. He's on the State Street Foundation's Corporate Allocations Committee and an executive sponsor of the firm's Latin American Professionals Group. Dan is a frequent speaker in the media and conferences on a variety of investment topics. He's also the vice chairman of the board and the Crispus Attucks Children's Center. We'll start the session with a presentation from Dan and then take it to a Q&A and a more interactive engagement with the audience. Please do share your questions on the app, and we'll try our best to relay it in the session today. With that, may I invite Dan Farley on stage, please.
Thanks, everybody, for having me here today. This is a great opportunity to be talking to you about this topic around wealth management. Obviously, it's a very important one, but I think at the time right now, in terms of what's happening in India especially, it's really, really exciting. I oftentimes, when I get into these thoughts around what's happening in wealth, I think of a story of a gentleman by the name of Willie Sutton. Most of you probably don't know Willie. He's an American. He was around in the 1930s, and he was particularly famous because he was a bank robber. Willie was a very good bank robber. He had a career of about 30 years. He acquired, we'll call it acquired, about $2 million in money, which is about $45 million today. So that's a pretty good haul if you're a bank robber, I'd say. And he became quite famous, so famous enough that he made the FBI's top 10 most wanted. So very much a known entity. When he was finally caught and apprehended, a reporter asked him, "Willie, why did you rob the banks?" He said, "Well, that's where the money is." I thought that's a pretty astute observation, and it speaks to me a lot in terms of why is everybody so focused on wealth management these days, right? Because that's where the money is. That's where the growth is. And I think that this is a particularly interesting time around that, because not only has wealth management been around for hundreds of years, right? This is not a new thing. But what has been happening is the pace of evolution, the technology that has been evolving around this, the ability for us to bring a delivery of holistic solutions, not only to the ultra high net worth folks, but all the way across the environment. And I think that is part of what, for me, makes this particularly exciting and interesting. In fact, there was a piece that JP Morgan's private bank put out about a year ago where they were talking about their outlook on private wealth. And what I thought was particularly interesting was what they said, right? They talked about a fundamental shift in technology. They talked about digital tools. They talked about data. And they talked about, personalized, effective client solutions. They didn't talk about stocks and bonds, right? They didn't talk about the traditional asset management things. They talked about tech, and they talked about customization. And I think that is so critical to where we are today in this conversation. So what I'd like to do in the time that we've got here together is cover off on a couple of things, do a really quick flyby on the status of global wealth and how that stands today, some market data, some statistics there. I want to talk then a little bit about what we're seeing as key issues for wealth advisors across our global practice and what we're seeing from folks there. And then drill in a little bit more in terms of some of the ways that we're thinking around asset allocation and what do we think are really important tenets to be taken away as you're working with your clients. And then we'll speak a little bit about what we're seeing from the business side of this and what we're hearing from advisors as being some of their challenges and things that they're thinking about. So that'll be our plan for the next 25 or 30 minutes. Before I dive into that, some of you may know State Street. I want to just a quick little details about that. Some of you may know us through our Spider ETF brand, but State Street Global Advisors is actually amongst the top 5 asset managers in the world with a little bit over $4 trillion. We've been at this for over 45 years, and the clients that we're working with range everything from institutional pensions and sovereign wealth funds all the way through wealth advisors and platforms. And so, very broad perspective on this topic. We do cash and fixed income, equities and multi-asset, which is my world, indexing, active, a pretty broad stroke on this. And so I think it gives us an interesting perspective in terms of what people are thinking about and some of the solutions that are being provided. So hopefully that'll come out in our conversation today. So let's talk about the wealth market and how we see that right now. This was some data that Oliver Wyman put together looking at the growth of both the institutional and wealth marketplace. And we can see right now that's roughly $60 trillion globally in wealth assets of the 104 total. We can see how that's expected to grow to almost 90 trillion over the course of the next 5 or 6 years. And what I think is particularly important about that is we start to compare the growth rates that we see in comparing an 8% compound annual growth relative to a lower number that we're seeing in institutional. And it's creating a very interesting shift. For the longest time, the institutional assets were the thing that was driving the bus, right? They were the big wealth funds, the big pension plans around the world. Right now, it's about an equal split in global assets between institutions and individuals. And if we fast forward to 2027, the expectation it'll actually be a little over 60% wealth and 40% institutions. I think it's important because it helps drive the businesses that we're all talking about here today, but that will also have an impact in terms of how it drives markets and what's going to be important to those investors. If we double click on that a little bit and start to think about where in the world are some of those assets sitting and why, not surprising, North America is the largest part about that pie at about $57 trillion, a little over about 45% of those assets. And I think, clearly the United States is where we see a ton of capital. There's a regulatory system that's reasonably well aligned that helps that to be a source of wealth management, which is great. But that's not where the growth is. If you look at what are currently some of those smaller dots, but with higher growth rates, Middle East, Asia are where we expect to see that. Now, they may not be as well aligned, right? But whether it be the demographic trends, whether that be the ability for technology to jump and leapfrog in terms of the delivery of wealth management services, I think for me, those are some of the biggest drivers that we've got. And if I think about here in India specifically, someone's got to get engine. We think about the regulation here in India, the fact how quickly that's moving and evolving to support wealth and wealth management. I think that's really quite interesting and ultimately very, very supportive. The other piece that I think is interesting is you start to look at this global picture about where wealth is being generated and how that's coming together and what that creates from an opportunity perspective. If we look at the last couple of years, this is just a bit of a snapshot of a few selected markets in terms of the growth rate and the evolution of wealth that we've seen per adult in various selected markets that we've got here. And you can see some really amazing growth rate numbers, and particularly in some of the emerging markets. Now, I don't have business in Kazakhstan, so I can't know if that 100,000% was exactly right. But I can say that what we are seeing in terms of that acquisition of wealth and the ability for the economic growth to work its way through the system, we're clearly seeing that. And so that creates an opportunity for wealth management to come in to say, how can we help these people with that? When you also look forward, huge opportunity in terms of the acquisition of amassing wealth. And I think it's interesting to see, where do we expect to see the increase in the number of millionaires over the course of the next 5 years? And again, this comes back to Asia, this comes back to the Middle East as those biggest drivers. And I think that's what becomes very exciting for us, because from a business perspective, that creates a great opportunity to amass a business that's going to be able to help these people. I think it also speaks to the evolution of their needs, their preferences, what it is that the industry has to evolve with them to be able to deliver. So that was really quick. I'm sure we're going to see lots of facts and figures today. I'm sure this is not particularly surprising to anybody in this room, but I do think it helps to set the base about what the opportunity is and why we need to be focused on it. So let's pivot a little bit here and talk about the wealth manager and what we're seeing as some of the key trends that wealth managers are focusing on in their businesses. I think the first thing that we've observed all around the world has been this shift to a more holistic solution. If I were to go back 10 or 15 years, a lot of conversation around products. Who's the best local equity manager? What kind of bond fund do I want to buy? And as people have amassed wealth and are starting to think about this problem a bit differently, moving away from which stock should I get, and rather thinking about these more holistic solutions, very focused on objectives, as opposed to, can I generate an extra 100 basis points of alpha in my portfolio? And PwC put a nice label on this I thought was quite interesting. They talked about that in terms of the difference between investment alpha and investor alpha. Right? Investment alpha is the stuff that we all studied in CFA 2, right? You know, how do we generate excess return? What are the best way to pick stocks? What are the best ways to do all that? And that's still important. I don't want to downplay that at all. That ability to be in the right strategies to generate the right amount of return, that's very important. But I think where this has pivoted to has been a conversation around the holistic view of the investor. Now that they have amassed wealth, what do they do with that? How do we factor that, not only the assets that we have, but the other things that they have in their life, into the portfolio? So thinking about tax planning, thinking about family asset integration, right? Do they have a business that's in a certain sector that we should take that into consideration into their investment portfolio? How do we think about wealth transfer and financial planning and all of those types of things? And, you know, here in India, with such a young population, some of those may not be so critical. But as that business evolves and as that wealth accumulates, these will become very important things. And so the conversations that we're having with advisors is them thinking about how do they bring that holistic solution to their clients. I think a big part of that delivery mechanism comes through this idea around technology as well. I mean, clearly, we've all changed how we interact with our financial advisors, how we interact with our money, and how we make decisions around that. And this client engagement level of technology is going to be critically important for each of us in the wealth advisory business to be thinking about. How are we going to be able to deliver information in an effective way? How are we going to be able to get the mind share of our clients because they're getting pinged from 1,000 different directions? How are we going to be able to give them useful, pertinent information and not just overwhelm them with noise? And where and how they want to consume that becomes very, very important. So that means the apps that we use, the websites, how we deliver data via webinars, et cetera, those are all part of that. We think about it in terms of how they might actually want to get that data. There was an interesting study that said half of younger generation investors get their investment advice from social media. that both scares the hell out of me and blows my mind at the same time in terms of who's giving that advice, right? How do we make sure that they're listening to the right people and evolving their solution for that? So that engagement, I think, is a huge opportunity for us. It also is a huge way to think about how we drive scale for our business. The ability to deliver solutions down market into what we would call the mass affluent has to be technology driven. And so how that works into your process, who you partner with there, becomes critically important. What I also find very interesting as we start to look around the world is the portfolios that advisors are putting together are evolving. No longer is it just simply a mix of, say, mutual funds or mutual funds and ETFs, but bringing in together segregated, separate account mandates. Now that's always been something that's been available to the ultra high net worth. That's not a new thing, but that ability to bring that down market, to be able to take into consideration, whether that be tax planning, whether that be any kind of personal investment considerations that our clients want to bring into that. That used to never be possible if you were talking about more mid-sized client accounts. That's very possible now. And so that ability to make sure that technology is integrated in there. And then lastly, how are we using technology to help deliver the solution itself and develop the solution itself? So it's not unusual that we might be using technology to help gather data or information as an input mechanism, but we're getting to the point where we can use technology to help devise that solution. And in some cases, it could be to devise the entire solution. In some cases, it could be a tool for each of us to help to manage through that. But that ability to work with the robo front end side of it, I think has to be part of the business planning that we think about for delivering for clients. And then lastly, this trend about the demographic shift. And I think that means different things in different parts of the world. In developed markets, it's a generational shift from older investors and asset owners to the younger generation. I think in places like India, it's a question of the wealth creation of that younger generation and how that is amplifying and accelerating. But net estimates of there's going to be over $70 trillion worth of wealth generated, that this millennial population is probably going to be amongst the richest that we've seen, okay? As investors and investment advisors, we've got to think now, how do we change our story a bit? Because the difference between talking to a 65-year-old versus a 25-year-old is very different. Their objectives are different, how they think about risk is different, the types of things that they're interested in is different. Again, looking at those young investors, they're more interested in some of the more exotic asset classes. They want to talk about crypto. They want to talk about collectibles. They want to talk about alternatives in a way that probably their parents hadn't even considered. Now, we could spend an entire conference talking about whether crypto is a good idea or not in your portfolio, but you need to think about it. And you need to understand how you want to think about that and how they should be thinking about that for the advice that you give them. And so it really sort of creates this situation where, as advisors, we need to almost be having like a barbell in our business. We're going to have some folks who are, in the savings and spending mode, and some folks who are in the asset growth mode, and we've got to make sure that we've got solutions for all of them, or else we're going to be boxed out of pieces of this. So thinking about that, I think, is very, very important. So one of the things that we talked about is this idea about behavioral. I just kind of skipped over that, but I think it's super important because I often think sometimes that our role as investment advisors is like money therapists to a certain extent. We've all probably had plenty of conversations with clients where they're either very excited about something positively or negatively, and we have to kind of, all right, let's moderate that a little bit, or let's talk them in off the ledge sometimes. I remember in the global financial crisis, I had a chair of an investment committee of a pension fund that I was involved with pick up the phone and say, we have to go everything to cash. I'm like, well, time out. I'm not sure that's the right call that we got to go on here. Let's walk that back. Let's think about that. And I think that part of our roles is thinking about all of those behavioral biases that individuals have. And I was so excited to hear that you've got someone talking about that exact topic later today, because I do think it's so important. There was one survey that we did recently that I thought was a great example of that. And this is less about the survey itself, but really about what it's telling us is the investors were asked, how optimistic are you around your personal financial opportunity, your country's economic opportunity, the United States, and global. And what I found really interesting about this statistic is that 70 to 80% of everybody said, my outlook is fantastic. Everybody over there has got a problem, right? Now, this is called optimism bias. There's been lots of studies around it, and again, this is probably a different topic for a different day. But I just think it's a really interesting behavioral situation that we've got to say, listen, we've got to work people through this to say, why you may not want to put all your eggs in your own basket, why you want to think about diversifying and building out those portfolios. So it's just one interesting example I thought we could use today. So I want to pivot here and talk a little bit more about asset allocation and to think about when we're building portfolios in the wealth marketplace, how do we think about some key critical elements that we want to put into play here. And I want to use two examples, one of which is this concept of target date retirement. And for those of you who aren't aware with what target date funds are, this has been a very popular investment strategy for retirement savings in the US, in the UK, Ireland. We're seeing some of it in Singapore, in Japan. So this is a bit of a global thing. But what it is it's a pretty simplified way for folks to think about how to save for retirement. And at its base front, the idea is, tell me when you think you're going to retire, I'm going to put you into a strategy or a fund that's designed for you, and it will evolve with you over time. So if I make it all the way to 65, I'm due to retire in 2035. I'm invested in our 2035 target retirement fund. All right? If you were younger, you might be in your 2070 target retirement fund. And the idea is that over time, you own more equities, it starts to de-risk and gets you ready to go into decumulation. And so I think it's an interesting concept, and we can talk more about this in the Q&A. But what I really want to focus in on right now is the fact of how understanding objectives is important across people's life cycle, and how we choose certain asset classes and certain investments to be made that might be appropriate at one point in time, but not as appropriate at a different point in time. So for example, if I think about the younger investors who would be at sort of the left-hand side of this chart, what are they focused on? They want to grow their assets, right? They need to generate the time, take advantage of time value of money and grow that as much as they can. And you can see from this sort of high-level chart, we would say you want to be 90% in stocks, all right? The 10% that we have in bonds are actually simply long-dated government bonds. Now, that wasn't great 2 years ago, but over time, what we find is that is a fantastic diversifier for equity portfolios. And so when you're young and you're trying to grow your assets, clipping coupon isn't important. Managing tail risk is, right? And so we want to own that as a diversifier. Right asset, right time in someone's life cycle, okay? As you get older, your objectives change. You're going to think about things like wealth preservation. One of the greatest risks people have as they approach retirement is the sequencing of returns, right? If you have a pullback in the market right before you're about to retire or right after you do, that significantly changes your experience as a retiree. You start to care about inflation in a big way, right? And so you want to make sure you're owning assets that will hedge that inflation risk. And you want to be thinking about longevity risk. How do you have enough growth so you don't outlive your money? Now, in a market like India, you're really focused on the left side of this chart, not as much on the right side, but I use this really as the example of saying, how do we want to make sure we understand objectives of clients? What are those asset classes that are going to help? I used the example before that we own long government bonds early in the glide path. Well, we don't own that later in the glide path, right? I don't want to take on that investment risk, the interest rate risk that long govies would introduce. I want to own more things that are going to be inflation hedging. I want to own maybe a little bit more credit because I don't have as much in equities. And so the point here is, as you're thinking about asset allocation for your clients, firstly, really understand what their objectives are and match up the asset classes that are going to work for them from that perspective. The second example I want to give on asset allocation is thinking about, drilling down into what asset classes and how you start to build that portfolio. And the example I'm going to give here is from our model portfolio business. This is an area that we manage about $5 billion for advisors around the world, giving them a risk-based spectrum of models that they can use for their clients, that their job is to figure out, is someone should it be more risky or less risky? And our job is to figure out the asset allocation that matches that. Now, to drill into this a little bit more, I'm going to use the moderate portfolio, which is basically a 60-40 stock to bond mix. But a couple of things that I think are important here. One, we're very much believers that globally diversified portfolios are important. All right, and so you can see here a little bit of a sense of the asset classes that we would want to have in any given portfolio. Now, this may or may not be applicable or directly usable by your clients, but it is, I think, gives you a bit of a sense of this. We start to build this using traditional mean variance optimization, right? It starts with our capital market assumptions. What do we think is the risk, return, correlation of various segments of the marketplace, all the stuff that we studied in CFA, right? We're going to think about that in terms of both short and long-term horizons, because I think that the risk profile over long periods of time is what we have to keep our eyes on, but we have to be mindful of possible short-term turbulence in the marketplace. Okay, so we're going to go through that process, and that's going to give us the first pass at this. We're then going to pivot the portfolio and look at it through a different lens. Back to my objective comments, we're going to think about what all these different asset classes and what role do they play in the portfolio. So where's my growth going to come from? Where's my interest rate risk? What might be my inflation hedged assets, my defensive assets in the portfolio? And to make sure we've got good diversification across that way of looking at the portfolio mix. And then we're going to pivot again, and we're going to think about factors. Where am I getting my growth and my value from? Where's my credit risk? What might be my cap bias? Small caps versus large caps in the portfolio. And what we find is that none of these are right, but they're all instructive, right? They all give us a different way to think about the portfolio in a way that we ensure we can align to those objectives that we talked about, and we can manage the risk as we go through there. So hopefully that gives you a little bit of a sense at a very high level, and we can get into more of this in the Q&A, but at a very high level, a couple of the things that we think are important when building wealth portfolios from an asset allocation perspective, and some of the techniques that we're using to get around through that. Mindful of the clock, and I want to get to some of our Q&A section here, but I did want to spend a few minutes on the business of wealth management. And we had an event about a year and a half ago where we had invited in a couple hundred wealth managers from around the world, and we had surveyed them and said, tell us about how you think about your business. What are some of the challenges that you've got? What are you thinking through this? And I'd imagine many of these probably resonate with folks in the room in terms of your businesses, but I thought it was particularly interesting, this idea about focusing in on where your value add is in this chain of delivering those holistic solutions for clients. If we went back 10 years ago, I think advisors were very much struggling with the fact that they need to be, the CEO, chief of sales, investment allocations, right? Manager selection, chief cook and bottle washer. They had to do everything, right? It was very difficult to run all of that. And what we're seeing from a trend perspective is that folks are coming back and saying, listen, what am I really good at? Where do I want to spend my time in order to enhance my business? And then who do I partner with to go about that? So if you think that your best thing to do is sales, then go out and sell and make sure you've got investment people to go with that. If you want to be the investment person, how do you bring in those other resources? If it's really around the more financial planning side of things, how do you bring in the other resources for that? And it comes back to this first point about time and making sure that we've got the appropriateness there. The other thing I think was interesting that they were very focused on was the human capital side of it. Who do they bring into their organization? How do they develop, retain, incentivize all of that going along? And I think that again goes back to where is their focus going to be? How do they bring in those resources? And then lastly, what are their goals for their business, and how are they going to grow that? What are they going to do in terms of organic growth versus inorganic? Are they going to merge? A key trend that we're seeing right now is that continuing advisors are being merging and picking up. There's PwC had a trend that said they expect in 5 years 16% of global wealth advisors will have either been acquired or merged in with somebody else, right? And so that's I think a big important thing to be thinking about your business and ultimately how that sort of drives. So that's been important at the advisor level. It's also been important at the asset manager level. If I think about our business, again, what are we good at versus how do we want to partner with others? And so, that's, allowed us to be thinking about whether those be robo-advisor front ends or platforms or other technology solutions that have supplemented our business. I think, to be honest, a company that's done this fantastically has been BlackRock, right? If you think about how they have said wealth is very, very important to them, what have they done from an acquisition perspective to do that? And I put this up largely to say, this business is going to cover a lot of different grounds, and we have to make sure that we're thinking about that appropriately, whether that be the technology side, the investment side. You can see all the deals that they've done, over the course of the last, 10-ish years. It's a lot. And I think that speaks to the complexity of the business, and it speaks to what we all need to be focused on as we kind of go through here. So I'm going to kind of pause there, Shimon. Maybe we can have do some questions now. But I think the last thing I would just say is that wealth management's changed a lot since Willie's time, back in the 1930s, right? I think it's become more sophisticated from the client perspective. It's become more sophisticated from the technology perspective. And I think it's requiring us to become more sophisticated as the investment advisors to bring folks there. So hopefully this gave you a couple of different ideas and thoughts on how we're thinking about it, and happy to get into the Q&A. So thank you.
Thank you, Dan. That was quite a good presentation, and I think the audience is fully warmed up for the day with this slide deck. We have a lot of questions coming in. I think those who still want to ask questions, just go on the app and you'll find a way to put your question. Dan, I think broadly, the deck covers the broad idea that wealth management in India is changing. The demographics are very different, but so are advisors looking at ETFs and passive investing. And somewhere we feel that the views are very not myopic, but very unidirectional. You either have a house that says let's go passive, and we have a house that says let's go active, and somewhere we believe that these approaches lie in between in a continuum. So how do you think advisors think about both these approaches in the US, and how would you advocate this from an Indian context? Because there is relative outperformance for active managers quite a bit in India. And most investors we speak to are still focused on active management when it comes to markets like India. But how would you look at wealth advisors sort of implementing this approach?
Yeah. So I think there's a couple different angles to that question. I would say that we're increasingly seeing wealth advisors try to understand a bit where their skill set is and where their comfort level is. There's no question that the use of ETFs and indexing has been a huge pickup that we've seen not only in the US but really around the globe. And some of that is to the simplicity of that, and folks who have said, I'm going to very much focus on long term. I'm not going to worry about the ups and downs in the short term as that goes along. And that's fine. I think that's an okay solution. From our perspective, though, the answer isn't necessarily active or passive. It really is active and passive. And so as we build portfolios, we're very mindful to say we want to be thinking about where are asset classes or segments of the market that active management has a really good shot to outperform, right? The dispersion of return in certain asset classes like emerging markets, or here in India, you look at the difference between the best managers and the worst managers, there's value in being able to pick the best ones, right? You look at US large cap equity, that's a very narrow dispersion between the best and the worst, and very often they don't outperform the benchmark. So what we've said is identify where do we think are the asset classes that has the highest probability that managers can outperform. How does that fit into the portfolio that we're trying to construct, and those objectives that I talked about, and also think about the fee budget for the client. I don't want to pay a lot for active if there's not a good chance to outperform. I'm happy to pay it in an area where there's skill and where there's an opportunity. And so, as we've looked at various markets, and I think India is a good example of that, there is huge dispersion of return. And so there is an opportunity set there, but that doesn't mean you can't use other passive building blocks to support that in other parts of the portfolio.
So you would say that the ETFs would build the building blocks around the core, and then you have active managers sort of selected for various asset classes around it.
Yeah, that's absolutely a good way to approach it.
Sure, sure. But I think if we continue that discussion again, we had a lot of sessions on manager selection in the society forums over the last few years. And what we realize is that advisors are increasingly focused on manager selection, but at the same time, they're also burdened with the idea of, as you mentioned, of the business of wealth management. And somewhere maybe the advisors are trying to scale up very quickly, but every time we meet them, they say we don't have time to meet clients, we don't have time to explain performance, we don't even have time to sort of go and build out what we really did well for the client. But they have a lot of time for manager selection. So what's important here going forward? Is it asset allocation? Is it manager selection? Or should advisors rather rely on the markets, focus on long-term planning, and just spend your time more on building the business and the services around it?
Yeah. Well, the manager selection is the fun stuff, right? That's getting in, talking about the stocks and all of that. But from our perspective, that is maybe a second or third order step in the overall process. It gets a little bit back to my comments about understanding where your skill sets are, where you think you have aptitude. We would argue that the first important decision to make is around developing that strategic, longer-term asset mix that's right for that client. That's not to say that won't change over time, but to keep an eye towards that long term. I think that actually requires to spend the time with clients and making the time to spend that with clients to understand what that is. And so what we're finding is more and more the advisors are shifting that around to say, we're doing less of the manager selection piece of it and more the wealth planning side. Maybe controlling the asset allocation, maybe using somebody for model portfolios, right? And that the manager selection is, like I said, a tertiary type of piece of it. I think it also goes back to that active versus indexing side of things, that over the long term, you're more likely to have the asset allocation be the driver of the variance of the returns that you're going to experience as opposed to the managers that you select. So again, I think manager selection has its place. If you're going to be active, being good at manager selection is important. But I think it's if we think about what drives returns, making sure we spend the appropriate time on that would be our view on it. I think it also goes back to your point earlier about why some managers have gone to an all ETF approach, because they've said, we don't have skill in that, or we don't want to take the time for that, and we're just going to index it, and we're going to focus on that long-term view.
Sure. No, I think that's interesting, because I think the funds here are quite tightly regulated, So beyond a point, manager selection is more about trying to look for avoiding negative alphas in your approach, rather than trying to look for the best manager out there. So I think the focus is more on the governance side of things, and less on portfolio strategies. But I think one of the other questions that we have been debating in our groups is the idea of long-term investment planning, and moving away from just investments, but it's also overall financial planning. I think you mentioned about the demography in India being quite young, and there's a need to look at longer time horizons. And we see that target date funds have not picked up well in India. It's been tried earlier. It's been implemented in various forms and measures, but somehow wealth advisors have not really built out an approach towards target date investing. How do you at your day job think about this whole topic on targeted investing, and especially what are the capital market expectations that go into building out these kind of ideas?
So a couple things in that one. I think in terms of the long-term horizon, it's actually an interesting one. We did some work on this a couple years ago around the assumptions that people make when they start to build portfolios around time horizon. And if I was going to ask the question, say, everybody who's a long-term investor, please put your hand up. I'd imagine, thank you, someone did it, thanks for participating. I'd expect that most people would put their hand up, right? And having that eye towards those long-term goals and objectives, I think, are important. However, what we find as investors, and particularly our clients, is everybody's long-term until something bad happens, right? When there's volatility in the market, everyone gets very, very short-term focused. And so one of the ways that we try to build that into our modeling process And I'm going to geek out on some math here for a second. But if we think about the assumptions that we make in our capital market forecasts around risk, that when we think about that long-term strategic planning, most times people do risk forecasts looking at a series of monthly returns, okay? And what that gives you is a very volatile return market that if you actually looked at long-term realized returns or long-term realized risk, those assumptions are much higher. And so one of the things that we've done in our capital market process is said, for our long-term forecasts, we're actually going to use annual realized returns to calculate standard deviation. And we're going to use that in our first cut of optimization. But what we're also then going to do is use those monthly numbers, which are higher, which might emphasize those shorter term time horizons, and stress test those against those assumptions. And what that allows us to have what we call dual horizon view on this, because we know that while we want to think about long term and we need to have that as our North Star, that there are going to be those times where that volatility comes in play. And it allows us to have an interesting conversation with clients to say, this is what we think is the long-term roadmap, but if this happened in the short term, how does that affect your lifestyle or how you might think about the markets or your risk tolerance? And that dual horizon for us has been very, very important, whether how we build the models, how we build the target date funds, whatever that kind of goes into. On the return side of the assumptions, we're very much believers in thinking about, as an investor, how do you get paid, right? So as a equity investor, you collect your dividends, right? You've got earnings growth rate, real earnings growth rate, you've got inflation, and then you have price multiple expansion and contraction. Historically, those have been the big four drivers. More recently, mostly in developed markets, but we're seeing it more and more in emerging markets, share buybacks becomes a big part of that. And so when we try to forecast on the return side, we're going to look at all of those different things and say, at this starting point, how does that impact our forward look on these? So we're big believers that you want to use forward-looking risk return assumptions as opposed to historical. It's good to know what it might have done, but that's not necessarily the starting point. And so those are some of the into the weeds details of some of the things that we think about on that.
What's long term for you? You mentioned you have a tactical approach and a long term horizon, but what's long term for you in these models?
We typically model that out in sort of like a 10+ year. You'd like to talk about 30, but I think people have a hard time rationalizing what 30 years look like. So we think if we model around 10+ years and then think about what some of those shorter term implications might be, that gives us a good balancing act for portfolios.
Sure. And where does India fit into this model portfolio? I mean, is it more tactical right now? Is it structural? Is it both? And how would you compare and contrast that with some of the other emerging markets in your model portfolio?
Yeah. So I think from a global perspective, India is going to fall within our context of emerging markets. It happens to be an area that we're positive on, and so we are tactically tilted there a bit. That's also a segment of the market that we think active has a propensity to outperform. And in our active strategies, India has actually been a pretty strong overweight in those portfolios as well. But from an asset allocation perspective, we haven't broken it out that way.
Okay.
Now, that's fine if you were sitting in New York or Sydney, but I think if you were sitting in Mumbai, you're going to ask the question, how might home bias work into that? And I think, obviously, maybe not quite the 80% that we saw on the behavioral chart I showed earlier, but this is one of those markets that I think it does make sense to have more of a home bias than other places in the world, but I think it's a question of how you want to moderate that in the portfolio.
Okay, so I think I get your point. You say that the home bias chart that you mentioned, it could be possibly 90% or 95% if you ask the audience here for India, but then is that being too biased with near-term information? Would you suggest some approach to being more disciplined, or do you believe that we should be going by our biases because eventually it works out well?
Yeah. Look, I think that you need to ask yourself what it is that's driving that bias. If it was simply a bit of a flash in the pan type situation, then I think that would create the environment that you're talking about. But I think this is a market that if you look back and say, let's not talk necessarily about the short-term side of this, but rather the long-term I mean, the demographic story here is strong. The regulatory story is evolving, right? The flow of capital has been important. I think all of those help to create a longer term mix on that as well. Now, I'm not saying you should put 100% of your money in that one thing, but I think it does say it's not just a short-term move.
Sure. So I think the answer we get is you're positive in India,
Yeah.
and at these levels also you see India to be a structurally good market. So that's great to hear. I think we'll just shift a bit direction here in terms of your outlooks. We realized that earlier this year, or possibly in April, you mentioned about 3 to 4 US rate cuts happening in 2024, and we haven't seen one yet. But possibly we are expecting, as you mentioned, a few rate cuts down this year. But what's your assessment of the U.S. economy, the earnings, and how would these rate cuts be viewed by the markets going ahead? Would it be, we are already at a pretty healthy GDP for the U.S. The numbers came out earlier this week as well. How would you evaluate the rate cuts?
Yeah, so our view on this is that we think that the U.S., specifically to your question, but the global economy broadly, is a pretty significant transition point at the moment. It has been outperforming what many people had expected over the course of the last 12 to 18 months. But the full brunt of the monetary policy tightening that we've seen over the last couple of years, we think is being felt now. So if we all go back to our economics textbooks, we know that it takes 12 to 18 months for monetary policy to transition into the economy. And if you go back 12 to 18 months from now is when central banks globally were at their peak of tightening. And so our view is that while the most recent numbers have been stronger and stronger than we would have expected, that we probably will start to see an acceleration of the deceleration, if that makes sense, as we get into the back half of the year. And so as it relates to the Fed and their policy, we're actually quite concerned that they are falling behind. That we don't think that recession this year is in the cards, and that's not an outlier view. And we still think that there's an opportunity for a soft landing here. But the longer and later that they end up being that holdout, right? Bank of England has cut now, so we're starting to see that the US Fed has been a bit of an outlier here. But the longer that they wait to start to ease from a monetary perspective, that increases the probability of recession next year. And if we think about it from the growth potential, like our view is that we're going to see about a 2.5 global growth this year, slowing to low 2s next year. In the US, it's probably sub 2% growth rate. 5% Fed funds is a long way from neutral, right? And unless they're going to move very quickly and very sharply, which the market is not expecting or pricing in, they're going to get behind the curve. So we think that they've got to get on this thing in September, and that will start with this year and into next year. And in terms of market impact on that, clearly market's pricing in, it's almost 100%, I think it's 97%, yesterday, of a cut in September of at least 25 basis points. They're expecting that to come, and we're starting to see that price into markets. What I worry about this, though, is rate cuts are a good thing until they're not. They're a good thing if it's reasonable growth and we're removing excessive tightening. If it's things are coming off the rails, we gotta cut quickly, that becomes a bit more of a challenge for markets, because I don't think that's effectively being priced in at the moment.
So essentially you're saying that the Fed should preempt a possible recession and start cutting rates now, because the lag effect is coming in quite strongly now.
100%, and we would have argued they probably should have started that a couple months ago.
Okay, so I think continuing with that topic on outlook, I think we had a question coming in from the audience as well from Kapil. There's been a huge divergence in investment returns between India and China, and we know that geopolitics has a bigger role to play in what's happening in China. But how are you viewing this, and how do you correlate this with your rate cuts in the US?
So, as we've thought about allocations across the capital markets, we've been saying for a few years now that the need to break out China as part of people's broad emerging market allocations, largely from a risk management perspective, And I think what we've seen in the course of the last year or two has sort of proven that out to be the case. I think India clearly has been the beneficiary of a lot of the struggles that China has had. Some of it's geopolitical, but some of it continues to be their internal politics of how they're looking to manage that economy. And our perspective has been, whether that be the real estate segment that they've looked to come under control, what they've tried to do to be export driven and drive that part of their economy, that's got headwinds to it. And so, I think on the export one, for example, China has done a great job. They're now the largest exporter of electric vehicles in the world, right? Good on them. Obviously, the U.S.-China relations has been challenged in the tariff conversation that we all know about. But it was interesting that Europe and China was very tight, and they had good trade going on until China became the largest exporter of vehicles and the largest manufacturer of industrial equipment, which is exactly what the Europeans are really good at. And then all of a sudden you see that there's trade tightening conversations going on there. And I just use that as an example that we think it's going to be a while for China to be able to work themselves out of this slowdown. China's not going away. They will continue to be a big economic force in the world, but the next year or two is probably going to continue to be a challenge. And that's probably to India's benefit, right? Both in terms of capital investment and infrastructure and trading partners. India's probably done a very nice job of kind of being a bit neutral in all of these kind of conversations, but then also in terms of capital flow. The return of India has not gone unnoticed. And I think that you start to see, we're having more conversations where people are saying, should I be breaking out both China and India as part of my capital markets? We haven't seen a lot of people doing that from an allocation perspective, but the conversation's coming up more and more.
And that's great because the next question obviously was on gold as an asset class. And in India, we've just had the recent tax budget out where they've sort of equalized all asset classes. So I think it's actually good times for CFA charters here because investment metrics will decide how we allocate across asset classes and not taxes. But what's your view on gold as an asset class and the fact that Indians continue to add gold both personally as well as from an investment standpoint?
Right.
And given that markets in India are already at lifetime highs for a long time now in the last 18 months, would you rather advocate gold as a strategic asset class going ahead?
Yeah. So we think gold has a very important potential role to play in a portfolio. It can be a diversifier, it can be an inflation hedge. It's really quite an interesting one. It has different components to it. We very much like to include it as part of a tactical opportunity set. We think that there is absolutely times when you want to be in gold and there's good price momentum behind that. We're in one of those times right now. We are overweight gold in our tactical portfolios. Strategically, I think it depends a little bit about who you are and where you are and what your objectives will be. So, is gold a high growth asset? Probably not, but it could be a good diversifier for those types of investors. It absolutely can be something for those participants who are more risk averse, who are more inflation sensitive, and it can play that component to a portfolio. So, I very much think it comes back to the chart we were looking at earlier when we were talking about target date funds and that idea of saying, what are those core objectives that someone's got, and making sure that you've got the asset classes in the portfolio that can either drive or hedge appropriately.
No, interesting. So obviously we've spoken about gold, we've spoken about emerging markets to some extent in China, but I think the more interesting comment that came from you is the rate cuts anticipated by you down the year. But at the same time, you've also mentioned that you're advocating high debt in the US. You're also possibly advocating long duration bonds, given that you can go down the rate curve as well. But what's the risk here? I mean, what happens if there are concerns in the US fiscal situation? We have elections coming up as well, and we don't know how things will pan out in 2025.
Yeah.
So how would you sort of assess this view of yours to look at long duration or high yield credit? And are you being very optimistic about the US economy ahead, or rather are you being tactical from seeing that there's real returns on the table, let me just eat it up.
Yeah, look, I think we're at, as I said earlier, at a very important transition point in terms of that outlook. And so each of them probably have their own story or reasoning behind it. As I said earlier, we are expecting the broader economy to slow down, but we don't buy economies, right? We buy markets, we buy investments. And the reality has been to date that even though the economy has been slowing, still reasonably good, but slowing, markets have ripped, right? And why is that? And from our perspective, there's been a couple different reasons. One, from a bottom-up perspective, is you look at things of like realized and expected earnings, that's been very, very strong. Things like price momentum has been incredibly strong, particularly in the U.S. The quality of companies has been very, very good. And we define quality a couple different ways. Some of it is the metrics that we would all expect around balance sheets and the like, but we also think about that in terms of share buyback and the role that that's been playing. And so even though the economic story has been slowing and there are definitely things to worry about, these other areas have been pretty good. And so we've been overweight equities for the last 18 months, but we've been pulling that back here over the last couple. Some of it because everything I just said is true, but valuation's not great, right? And as the market keeps going up, that valuation gets worse. And so we try to balance those things off. If you look at investor sentiment, investors, as much as we've talked about things to worry about, have been pretty switched on in terms of their willingness to take on risk. And you've seen that manifest itself in terms of capital flows to equities. That too is changing. And so again, it's this inflection point. So you mentioned high yield. We own high yield not because we think credit spreads are going to tighten here. That's actually not the case. But what we do think is that at this point, default risk isn't particularly high, and the coupon's pretty attractive. And so if we can clip 7, 8% in the high yield portfolio, not have a lot of default risk in an environment that is transitioning from stocks to bonds, we think that's not a bad short-term trade. On the long duration, it's a bit of a hedge against some of this, as we know. Long duration tends to be a good downside protector. But at the same time, we wanted to make sure we were sort of neutralizing our overall portfolio duration. And we even saw that in the move that we've seen in the treasury market here the last couple of days, where we've seen quite a rally there. And so, our idea there is not necessarily that we think that rates are going back to pre-COVID levels, but that somewhere in that 4 to 4.5% on the U.S. 10-year is probably about right, given the story there. So different drivers about why we own some of those things, but that's sort of the backstory.
But what part of the U.S. equity markets would you be optimistic on? Because you have U.S. large caps and you have small and mid, but
yeah.
And the question here is that we've got a lot of questions actually coming on this point is small caps, mid caps in India have done very well.
Yeah.
Almost, as we speak today, 65% of the market is large cap. It was much more a few years back, but how would you sort of segment your portfolio in the U.S. today between large and mid?
So from a U.S. perspective, we are tilted, again, it depends on time horizon and objective, so it's hard to give a strong answer, but if for those who have a bit more of a growth orientation, we've been overweight small cap. We're overweight tactically small cap, but even strategically, we would highlight small cap, small and mids, relative to their cap weights in the portfolio. To be honest, that's actually been a very difficult trade over the course of the last few years, last 15 years. And we're spending a lot of time trying to think about why is it that small caps have underperformed large caps. And next 15 are going to be like the last 15, it sort of blows up cap M and a lot of the things that you assume with that. And so, understanding what those drivers are is something that we're spending some time thinking about. I think from a local perspective, one of the things that we have very much always advocated for was ensuring that there was that allocation to mid and small cap. And because from a global investor perspective, if you just buy the straight up emerging market benchmark, pick your favorite version, and you look at that from a cap weighted perspective, the biggest companies that you're going to own are really global companies. They're categorized as emerging markets because that's where their headquarters are, but you're not really getting the flavor or the drivers of the local stories. And so we're big believers that mid and small cap exposures in these growth markets is how you actually play the domestic opportunity set as opposed to more in those mid-market piece.
That's great. I think we have less time, but one last question on wealth management again. So what are the challenges you see in wealth management today, and especially on the global side of things, and what would be your top 3 recommendations to advisors sitting in the room today?
Yeah. So I think, and this will echo some of the comments I made earlier, I think the biggest challenge for wealth managers is how do we deliver consistent, solid investment advice that matches up with the outcomes that people are looking for. And that means that a one-size-fits-all solution is not the answer. It means that we've got to identify the best ways to take as inputs those criteria that are going to help us make that right decision for those customized holistic solutions. Whether that be leveraging technology, whether that be making the time to sit and talk and meet with people, I think is the critical point, because there's a lot of distractions, there's a lot of things that are going to pull on firms. You know, big firms have a ton of resources, smaller firms have to pick their time very, very carefully. And so probably my biggest takeaway would be, as I said earlier, really think about what your value add is, what you're going to bring to that equation, and make sure you're supporting yourself around that with partners, that you don't have to do it all, that you really think about how you can align all of those resources to what's going to deliver for clients. And that's how it'll be successful for them and successful for you.
Okay, last 10-second question. Cryptocurrencies, we've had some feedback from the audience. How do you think about it? How do you invest in it, if at all? It's part of the ETFs.
Yeah. So our view on crypto right now is from a trading tool, from a tactical tool, it has a place in the portfolio. Price momentum is a huge factor that you can see and try to use to time portfolio positions in crypto. We have not taken crypto as a strategic allocation. We're trying to really determine how do you figure out how you value it, how you think about and forecast its return. So that's a bit of a wild card for us. You know, that will evolve. I think we're still early days in this conversation. But there's definitely a role to play. We think it's more of a short-term trade role as opposed to a strategic role at the moment, but you know, we'll see how that evolves.
Okay, thanks Dan,
Great.
for your time here.
Thanks very much for having me.
Thank you.